Hey, how's it going everybody? Harrison George here with the Harrison George team, and we're gonna walk you through several videos on what this all-in-one loan is, how it works, some of the methodology and qualifications and costs behind it, and then lastly, we will walk you through the simulator. So let's get into it. At the end of the day, this product is nothing like a 30-year mortgage. So I kind of want you to just forget everything you know about a 30-year mortgage, because the only thing that this product and a 30-year mortgage has in common is the fact that it is 30 years. But because this loan is nothing like a 30-year mortgage, it allows for individuals to take advantage of so many different benefits than a standard product. This product is the combination between two major components. It is the combination between a checking and savings account and a home equity line of credit. Let's walk through each of these so you can kind of understand individually what it is, and then we'll combine them and explain to you what this product is together. So a home equity line of credit is a big credit card on your home. And as you continue to pay down that credit card line of credit, you will begin to see available access to the individual that can be used for whatever you want. Like all other lines of credit, your payment on this product is going to be based off of an interest-only payment on your home. When talking about this product, most people get confused when thinking principal and interest because they're so used to seeing that in a 30-year product. This product separates those two. As individuals earn their income, it gets applied to their principal, and their payment is based off of the balance. The second product, or the second part of this product, is the checking and savings account. Because we've merged these two accounts together, all your income no longer goes to your current banking institution. We will create a new bank account for you, and this new bank account will have a linked communication between this checking account and the line of credit. So as you earn your money, that money gets applied to your mortgage balance, and as you pay your bills off, that balance is going to go up. As it wiggles its way down to a balance of zero, your payment is only going to be based off of what you owe on this product. So as you continue to pay it down and your payment associated with what is owed on your product goes down, you begin to save more money monthly. As you could imagine, most people don't just spend an extra $200 every month if they save an extra $200. So that money sits in this account month over month. You continue to pay that home off at an expedited rate, allowing for you to save tens to hundreds of thousands of dollars in interest. How this loan works. So unlike a 30-year mortgage where you earn your money into your normal checking account and you pay your monthly mortgage payment, we are going to essentially combine those two with this product. So as you earn your income, it will get deposited into your checking account with this product, and at 11:59 Eastern Standard Time, every single night, any dollar that's in that account will be swept to your mortgage balance. And your payment is just going to be based off of your mortgage balance calculated at midnight. Over the course of the month, this calculation is going to be done on a daily basis. It will add up the interest calculation for the course of the month and pay it out on the 21st of the following month. As you go through the course of the month, you're going to obviously have additional expenses. You're going to pay them from this line of credit. Now, this product really only works for individuals that are cash flow positive at the end of every single month. And if you're saving more money monthly on average than you spend, you're going to see an increased balance drop over the course of the life of the loan. As you could imagine, your mortgage balance calculation at a $400,000 balance is going to cost more than at a $300,000 balance. But at a $300,000 balance, you will have a reduction in your payment, which will create a snowball-like function to allow for you to save more money monthly, which will then sit in your mortgage balance, which is then just going to be an additional payment or an additional drop in what you owe at the end of every single month. As you save more money, you save more money. Now we're going to walk you through the qualifications associated with this product. To begin with, we're going to be talking about a purchase transaction. For a primary residence, you are going to need at least 10% down on your home. However, anything less than 20% down is going to require for a one-time mortgage insurance cost paid for at closing. If you do decide to do 20% down, there will be no mortgage insurance cost that you need to experience. On top of that, for primary residence, you need to have scores above 700. The better the score, the cheaper the cost of the product is going to be. And lastly, we're going to need to see debt to income ratios below 43%. In fact, there's a little bit of additional information with that. If your debt to income ratio is between 40 and 43%, we will need to see a reserve component, which is going to be based off of your line of credit amount of 15%. So if you have a $400,000 line of credit amount, we will need to see $60,000 in assets somewhere in a checking, savings, stocks, bonds, 401k, cash value whole life insurance policy, and so on. Feel free to reach out if you have any questions on what those reserve components can look like. If you have debt to income ratios below 40%, then we only need to see 10% of your line of credit in reserves. So at a $400,000 line of credit amount, we need to see $40,000 in reserves. The same is true for a second home, other than the fact that you have to do 20% down. And lastly, for an investment property, the down payment is going to be 25% on a purchase, and you have to have credit scores over 720. Now, when looking at a refinance into any of these products, the same is going to be true for a primary residence refinance. We're going to need the reserve and the debt to income ratios to remain the same. However, if you owe between 80 and 90% loan to value on your home, we are going to only be able to do a rate and term refinance, meaning that we're going to need to pay off the mortgage, add the expenses associated with the product into that, and that will be your loan amount and line amount. If you're looking to do a cash out all-in-one and you owe less than 80%, the max you can go to is only 80%. This is the same for a second home. The max is going to be 80%, and an investment property, the same is going to be true, but a cash out goes to 70% and a rate and term only goes up to 75%. Obviously, if you guys have any questions, feel free to reach out to us. There's links below that you can reach out and ask us any question that you'd like. The costs associated with this product. Again, we're going to just do this based off of a $400,000 line amount on a purchase of a $500,000 property, and we can extrapolate that from there if you have a different scenario. So when looking at this loan, we're going to be talking first about the cost for the interest rate. The interest rate is made up of two components. It is made up of an index, which is the 30-day SOFR, the secured overnight funds rate, and it's going to be added to a margin. That margin is going to be your choice. It starts at 2.5 and goes all the way to 4% in 0.25 increments. There are different costs associated with each of the margins, with 2.5 being the most expensive and 4% being the cheapest. That cost for a standard 3.5 margin is going to be about 1% based off of today's numbers, meaning if you have a $400,000 line amount and loan amount, you're going to see a $4,000 cost for that margin option. After that, we're going to talk about our lender fees. Our lender fees are about $1,500, and then you have a appraisal on the property, which can range anywhere from $650 to $1,000, and that could change depending on your area and the property value. After that, you also have title fees. Again, depending on your value and property, that could be anywhere from $2,500 up to $4,000. All of these fees at the end of the day are going to be very similar to any other 30-year mortgage you're going to be acquiring. After the title fees, you're going to have your homeowner's insurance, which is just a one-time cost for the first 12 months of your loan, which is going to be paid for at closing. Everything after that is going to be based off of you making those payments. In fact, there is no escrow account with this product. You pay taxes, you pay insurance. And the philosophy behind that is, why would you be giving somebody else your money to have them make those payments for you if you could have that money sit against your home until you make those payments? Lastly, the thing that is unique with this product, which is not a cost, but is very nice to know about, is there is something called an initial draw adjustment. This initial draw adjustment at the end of the day is going to be 1% of your loan amount. Think of it as the first deposit into your bank account. If you go and open a new bank account somewhere, they're going to say, hey, please give us $1,000, $5,000, or so on to open your account. Conceptually, this is the same thing, except we are just taking money from your left pocket and depositing it into your right pocket for your first deposit into this product. I mean, at the end of the day, we are creating a new bank account for you. Other than that, there are no additional costs to this product. Realistically, this product has similar costs to any other 30-year mortgage that you would be getting. It just has some of those additional caveats like that initial draw adjustment, which again is not a cost, it's just money moving from left pocket to right pocket. Thank you so much for checking out this video. There are some links in the description to additional material. There's going to be some additional links as well for you to schedule an appointment to see if this product works for you. And on top of that, there's going to be some more videos coming up to talk more about some additional features of this product. Thank you so much for watching.